WeWork, the name alone brings to mind images of beautiful offices, free-flowing kombucha, and a valuation that soared to an incredible $47 billion. It was more than a company. It was a movement, led by a charismatic founder, Adam Neumann, who promised to elevate the world's consciousness. But in less than a year, this tech-adjacent real estate giant came crashing down in one of the most spectacular corporate implosions in recent memory. So what happened? Was it the wild parties, the eccentric CEO, the flawed business model? Those were all symptoms. The real turning point, the one decision that sealed WeWork's fate, wasn't about any of that. It was the decision to go public. Let's rewind. By early 2019, WeWork was the darling of the venture capital world, fueled by billions from SoftBank's Vision Fund. Adam Neumann was a master storyteller. He wasn't renting desks. He was selling community, a global network, a physical social platform. He convinced investors that WeWork was a tech company, deserving of a tech company's astronomical valuation, not a boring old real estate company. And for a while, everyone bought it. The company was expanding at a breakneck pace, opening new locations in cities all over the world. The mantra was growth at all costs. Profitability could wait. The problem was, the faster they grew, the more money they burned. Each new lease was a massive long-term liability, while their revenue came from short-term memberships. It was a fundamentally mismatched and risky model, but as long as the private funding kept pouring in, the party could continue. The pressure was mounting. SoftBank and other investors had poured billions into the company and needed an exit. They needed to cash out. The only way to do that on such a massive scale was through an initial public offering, an IPO. And so the decision was made. WeWork would go public. This was the single most critical choice in the company's history. Going public meant opening up their books to the world. The smoke and mirrors, the talk of community-adjusted EBITDA, and the tech company narrative would all be put under the harsh, unforgiving microscope of Wall Street and public investors. The story would no longer be enough. The numbers would have to speak for themselves. This decision triggered the chain of events that would lead to total collapse. It wasn't just a financial move. It was a reality check that WeWork was simply not ready for. In August 2019, WeWork publicly filed its S-1 document, the formal registration required for an IPO. The world finally got a look under the hood, and what they saw was terrifying. The filing revealed staggering losses, $1.9 billion in 2018 alone. It laid bare the company's bizarre corporate structure, which gave Adam Neumann an almost untouchable level of control through super voting shares. It detailed numerous conflicts of interest, like Neumann personally buying properties and then leasing them back to WeWork, or the company paying him millions to use the trademark for the word "we," which he owned. The S-1 wasn't a prospectus for a revolutionary tech company. It read like a cautionary tale. The reaction was immediate and brutal. The media, analysts, and potential investors tore it apart. The carefully crafted narrative of a world-changing tech unicorn evaporated overnight. WeWork was exposed for what it was, a real estate company that was losing an unbelievable amount of money, run by a founder with questionable judgment and too much power. The fallout was swift. The proposed valuation of $47 billion became a joke. Bankers scrambled to slash the number, first to $20 billion, then to $15, then maybe even below $10 billion. The public market wasn't buying the hype. They wanted profits, or at least a clear path to them. And WeWork had neither. The IPO, which was supposed to be the company's crowning achievement and a massive cash injection, was now in jeopardy. The very decision designed to secure the company's future was now threatening to destroy it. The emperor had no clothes, and the S-1 filing was the little kid on the street pointing it out for everyone to see. The trust was gone. Investors pulled back, and the internal panic at WeWork and its primary backer, SoftBank, must have been immense. The plan had backfired in the most public way imaginable. Faced with a disastrous public reception and a cratering valuation, WeWork had no choice. In late September 2019, just weeks after filing the S-1, the company officially postponed its IPO, but it was too late. The damage was done. The failed IPO attempt had cut off WeWork's access to a crucial line of credit that was contingent on a successful public offering. The company was burning through cash at an alarming rate and was suddenly staring at bankruptcy. The growth engine had run out of fuel. The one decision to go public had set off a domino effect. It exposed the flawed business model. It highlighted the poor corporate governance. It destroyed the public's trust. And it cut off the company's financial lifeline. The collapse was no longer a possibility. It was an inevitability. The final act was a bailout. To save its own massive investment, SoftBank stepped in, taking control of the company in a deal that valued WeWork at just $8 billion, a staggering drop from the $47 billion peak just months earlier. As part of the deal, Adam Neumann was forced to step down as CEO and walk away, albeit with a golden parachute that was itself a source of major controversy. Thousands of employees lost their jobs. The grand vision was in ruins. So why was the decision to go public the fatal one? Because it forced a reckoning. In the private market, a charismatic founder can sell a story. Valuations can be based on vision and potential. But the public market is different. It's a world of quarterly earnings, profit margins, and intense scrutiny. By choosing to enter that world before they were ready, WeWork's leadership put the company on a collision course with reality. The IPO wasn't the cause of the problems, but it was the catalyst that made them all explode at once. It was the single action that held a mirror up to the company, and the reflection was not what anyone wanted to see. The story of WeWork serves as a powerful lesson for the startup world. It's a story about the dangers of a growth at all costs mentality, the importance of sound corporate governance, and the critical difference between a compelling narrative and a sustainable business. It shows how unchecked ambition and a lack of accountability can turn a celebrated unicorn into a cautionary tale. The one decision to go public didn't create WeWork's problems, but it exposed them to the world in such a spectacular fashion that the company could not survive the fallout. It was the moment the magic trick was revealed, and once the audience knew how it was done, the illusion was shattered forever. Thanks for watching. If you found this breakdown interesting, make sure to like this video and subscribe to our channel for more deep dives into the critical decisions that define the rise and fall of major companies. Let us know in the comments which company's collapse you'd like us to explore next. See you in the next one.